Good evening, everybody. Thanks for taking your time to this seminar tonight. And the title for tonight is China Macro Outlook. Where does China recovery go from here? I suppose most of you have some interest in investing into China-related stocks or products. Maybe a show of hands, who are now vested in China already? Wow, that's 80%. Who has not but are looking to go into China? 4%. So maybe there's 10% who are thinking of neither. So it's good to have you here because you'll be happy to know that we have lined up a number of key speakers. They are the experts of their own domain, including my dear friend, Mr. Jeff Howie tonight. He's our market strategist. So Jeff has over 25 years of experience in financial markets and economic analysis. He is also the creator and author of our My Gateway report that highlights the local market highlights and also developments, and he has been serving the investors locally since 2012. We also have with us today Mr. Tan Teck Ling. He's the CIO of Phillip Capital Management, and he's a good friend of mine as well. I know him for many years. They are a key ETF issuer in Singapore. So he's the deputy CIO of Phillip Capital Management. He's a key member of the investment team who cover global equities and fixed income markets, including both active funds and ETFs. He also manages the equity and balanced funds portfolio. We do have also with us online, later on you will see him, Mr. Alvin Lee, Director of Equities Derivatives Sales Asia. He's responsible for business development, sales and marketing for daily leverage certs. Anyone has heard of DLCs? Okay, good, about 8% maybe. So Alvin is expecting this, and he'll be sharing a little bit on how investors can use DLC to gain amplified performance of their investments. And last but not least, we also have Ms. Liu Miao Miao with us. Ms. Liu, she will not be joining us at the panel, but she will be giving you an insightful sharing right after the panel on some of the Singapore stocks that has exposure to China. So Miao Miao is a member of the research team at Phillip Securities, covering both REIT and also airline sectors. Prior to joining the company, she graduated from SMU. So without further ado, may I welcome our dear panelists, Jeff and Teck Ling on the stage, and we will then be joined with Alvin as well. Hey, it's first time actually having a seminar that starts with a panel. Normally you start with a presentation, but I hope you find this interesting. So we are going to dive deep into China market. We are going to ask some questions that probably many of you are keen to find out. But during this period, if you do have any questions in mind that we are not covering, feel free to scan the pigeonhole. There are two barcodes at both sides of the screen. You can submit any questions that you have. Burning to know, right, that we are not covering today. And we will try our best to touch on most of the questions. So to start off today's discussion, I've been following a bit of the China's news more closely, leading to this panel. And certainly one of that highlights that caught my attention is the recent GDP results. It failed to meet expectation, 4.7 last quarter. So maybe the first question I do have in mind is, maybe your thoughts about what does this tell investors, and what does this how should investors really read such economic indicator? And recently, we also heard through the third plenum that China is going to do a lot more supply side push for high quality developments. How are these supportive measures helping, and how should investors treat these when it comes to investing into China? Maybe I can start off with Jeff.
Sure. I think the target is still for 5% GDP for this year, as you said. The thing is, there's so much going on in the world, which China is still a very key part of. You know, the manufacturing powerhouse, 15% of the world's global merchandise exports, and veiling gradually some very significant industrial reforms. So I think you always, and we've all learned this, when it comes to China, you have to take a different lens of data and indicators and policies that you would take to, say, the US. So monetary policy means everything in the US, as does the inflation data, but that's obviously very different in China, although the US is clearly reindustrializing itself. The FDI, the portfolio inflows to China, have reversed during COVID, going back into the US, reindustrializing, reshoring its manufacturing base. China has still remarkable opportunities, as the markets have shown. FTSE China A50 index, there was concern about foreign investors moving out last year, but the open interest, which is always our own prism or our own lens of look, institutional investors are maintaining their interest in the China market, is up around 25% from those lows back in the third, fourth quarter of last year. So there has been a recovery of confidence. For the technical analysis, it's pretty amazing when you look at the FTSE China A50 index and you look at those declines from February 2023 right through to January 2024, you've had a 50% recovery to the highs in May, and range trading somewhat between, I guess, the 33% level and the 50% level. And there's been, I would say, less than a handful of key structural reforms with that industrial policy slant that has provided the direction. The first was really important when the CSRC insider Wu Qing was promoted to the head job in early February. And he did say, look, we're going to execute a number of market stabilization methods. And they did deliver right through to the end of April. And that provided a lot of stability in the market. And we saw in our FTSE China A50 index, for instance, a lot of broad gains. It had a really big broadening impact. So the rally was about 10%. And you had 9 gainers for every 1 decliner in the FTSE China A50 index. Now you compare that to that 15% rally where it was a year before, a year and a little bit more than that before. You had a 15% rally, but it was very uneven. You had 3 gainers for every 2 decliners. So that was the first step. And the second step, obviously, March, the new quality productive forces. That is essential. The trade-in program, your trade-in program for the consumer goods and the cars to go more green and more digital where can. So the green sustainability and the digital trends are part of that. That adds, one of the big banks here said, forecast that adds 1 billion renminbi in demand and 4 billion renminbi in recyclable output. And you compare that to GDP in China is about 125 trillion renminbi. They're about 125 billion trillion. Whatever it is, it's 1 divided by 125. The other aspect I think that is super important is the property market. But again, you don't take the short-term fix. It's always a long-term gradual industrial policies. If you look at the big property slowdowns across all the other big countries of the world, you wouldn't expect property market in China to really turn around until 2026. And again, there's 5 key structural reforms that are going to be a part of that. Obviously, having a little bit more of a less rigid housing pricing mechanism is important. Obviously, having, speeding up the exit of the non-viable developers, supporting with balance sheet measures and allowing them to adapt to a smaller market is really important for the viable property developers. And then obviously completing what needs to be completed, which we've been seeing more steps made to. And obviously the fiscal, I guess, local government frameworks also have to be revised as we go up to 2026, which will take more role. So there's some of the key areas. Just one more minute, and I'll be really quiet for a while. Sorry, Alvin. One more thing is the reforms. They're significant and substantial, as I said. So 5 of our biggest China plays in terms of, 5 plays that have attracted the most net institutional inflow so far this year. 2 of them have had very strong outlier performances around, one's a little over 200% since the end of 2019 in terms of gains. One's a little less than 200%, around 180%. Both have been on the right side of structural reforms in China. One, not just China, but more across the world with the move to green shipping and more fuel-efficient solutions for global shipping, and the other in TCM and reforms to clean up the TCM market. And that company was also on the right side of that. So just because it's a different prism and we're talking about long-term structural type of initiatives that have a big leverage into industrial policy, doesn't mean the market opportunities aren't there.
Thanks, Jeff.
Maybe I just add to Jeff's observations. So some observations on my end. Firstly, as a country develops from a frontier market to a developing to a more advanced economy, the GDP slowing down actually is a natural consequence, right? Just look at, for example, Singapore. It used to be double-digit growth, then 8%, and then now, of course, now we are talking about easily just 2-3% year on year. So that's to put into perspective a 5% year-on-year growth for China. Of course, today it is quite a different economy from 2 decades, 3 decades ago. Secondly, of course, when you talk about China these days, there is 2 things that you generally think about, I guess. One is the property market troubles. One is the geopolitical tensions with the US. So these are some of the challenges that definitely I think we all understand now. It may not be that well understood a couple of years back when China was doing very well, at least on the stock market front, but it's well understood today. Property market-wise, we are talking about, I think some estimates are that there's 60 million unsold homes in mainland China. A very big number, but it's a big population too. But even that, I think estimates are it will take quite a few years to digest all of this without government help. So the keyword is without government help, right? But with government, because I think you also read about some of the central government's efforts recently, just 1-2 months back, where they are trying to get the local governments to take over some of this unsold inventory. So they are doing some things compared to say 1 year ago, 2 years ago. I think they were more passive, right? So there are some of these policy efforts that you can see now on the property front. Geopolitical wise, that is another thing that can't be helped. But when you put it into context, why are there geopolitical tensions now? Is because the US sees it as a geopolitical rival. And when they see it as a geopolitical rival, China must have been doing something right all these 2-3 decades, right? So when you look at it on the flip side, it does have some structural advantages. It's actually the world's second biggest economy by GDP. It has 2 or 3 of the world's biggest stock markets, Shanghai, Shenzhen, and of course include Hong Kong. That's 3, right, of the top 10 stock markets in the world, right? So these are some of the things about China. Then some key tech words nowadays associated with China. Under Xi Jinping, right? So there are a few key phrases that they always talk about, right? Dual circulation economy, right? High quality growth, common prosperity. These are the 3 probably just to understand China and its direction going forward. Maybe these are some of the key things probably you all can understand a bit about the meaning behind that So I guess to dual circulation, meaning no longer just an export-driven economy, but they're trying to promote domestic consumption. So about the 5% GDP and that the fact that they are sort of unable to reach this number recently, right? So I guess the export side is still actually following the long-term trend growth. It is still pretty robust, right? Easily 6 to 8% year-on-year growth exports, right? So on the manufacturing and production side, the export side is pretty robust. But the other engine that is supposed to be the dual circulation, which is the internal consumption, that's probably the problem or the slowdown, right? It used to be retail sales year-on-year growth could be double-digit percentage, but now you are looking at probably half that number, right? Maybe 5-6% year-on-year. So I think this is something that bears watching, right? And of course, the consumption part is also links to the confidence, and that confidence derives from the property, right? So if you have property that is going down in price, I think that will have a negative impact on your consumption sentiments, right? So that's the best watching. I think that's something worth appreciating. Second tagline is high quality growth. So they're talking about what that means is basically innovation driven growth. That's why they're trying to look at manufacturing, high-end manufacturing. The government is heavily subsidizing semicon, R&D, AI, and so on, right? So that's basically innovation, high quality growth. That's what they are referring to when they say quality growth. So that's something that we'll be looking out for. Of course, the third plenum that Wei Chin was referring to, it just happened over the last few days, 15th to 18th. And it's actually just today is the last day. But what they are actually going to announce is actually tomorrow. So as of now, I'm not sure, but probably this high quality growth will be something that some of the policies will be angling towards, right? Then common prosperity, right? That's the third tagline. Common prosperity. What that means, of course, you can't have a small bunch of people getting really rich and the rest of the population gets really unhappy as a result, because there is really unfairness in the sense. And of course, China is about socialism, right? So that will probably also figure in the third plenum's approach going forward, because that is really a medium-term planning meeting. So I think tomorrow probably there will be more details from the third plenum, right?
Let me stay with you for another minute, because you mentioned about geopolitical tension, and it happened that there's a question about what if Trump get elected. And also my second question is actually there is a lot more trade tension these days. Europe is now also considering, or rather has some form of EV tariffs. So what if it get worse? How should investors treat it if there are just more news coming about tariffs? How should they treat this news when they are holding like 80% of the crowd here have China investments?
Yeah.
What should be their attitude? And also in the long run, should this continue? What are the bright spots in terms of the sectors that they should look at?
Yeah, so probably my thinking, I think, is also what a lot of people believe is that right now the elections, in the US is actually sort of both parties are trying to outdo each other in terms of their hawkishness on China. So if Trump is showing that he wants to make America great again, right? So what that means is, of course, you want to make China worse so that America looks better. Another facet is probably that you want to move manufacturing facilities back to America, right? So that means, I think it thinks from a zero-sum approach in that sense. So that is the reason why most people think that a Trump election, Trump being elected president would probably be bad for China. But probably if you look at all this in context, that of course it will naturally be the case. If that's what the population seems to be looking for, then they would try to be showing their hawkishness. And there may be some tariffs and so on being announced and so on. So that is probably natural, right? But let's see after the elections, right? That may be another set of policies, right? I think in a sense, they used to be seen as joined at the hip, China and US, as close as 10 years ago, maybe, right? And it wouldn't be so easy to separate them in terms of manufacturing without triggering inflation. If you were to if you were to impose 60% tariffs on China imports, you know, all the simple things like the furniture, the toys, the electronics will all be suddenly much more expensive because all these are made in China. So you will be, even if they wanted to do it, a lot of impediments, and they probably will be more tactical in some of these things, I feel. And on Europe side, I guess China has more levers with regard to the tariffs that Europe plans to, say, impose on their electric vehicles, right? Because China is the biggest consumer of their luxury goods, for example. So you know, I ban you place tariffs on mine, then I will just place tariffs on your luxury goods. I think the levers, they have some levers to push. And another thing why Europe has been so applying pressure on China, I guess, besides being just because they are just following the US, their ally, is also that the war between Russia and Ukraine, and China has been seen to be supporting Russia. So naturally, Europe is the one that is going to be affected by this war due to proximity. So naturally, I guess this is also a lever that they want to apply on China. So China knows full well what they need to do, actually, right? Distance themselves from Russia, for example, if they wanted to. It is a complicated set of calculations, right? Ultimately, I think there will be some consensus. Yeah, it's not easy to untangle all these things, but my expectation is that, I guess, long and short of it, that eventually there will be some pragmatic policies after the presidential elections in consideration of all these things. What sectors may benefit? I guess if you were referring to a Trump presidency, I guess they have always been talking about that the conventional energy will benefit and so on. Right? On the US side, right? For China, probably I think it makes sense to just look at their general direction of their government's policies in the long term, which of course means that one of the focus has to be self-sufficiency now, because regardless of what happens, I think the developments of the past few years means that they have to be self-sufficient in the high tech, right? So you know that is one angle that they have been looking at. I guess also the certain sectors that may benefit more. It is really depending on government policies quite a fair bit. For example, I think recently, I think the government was encouraging some replacement of old household goods for new, right? So that sort of benefited the household appliance makers such as Gree, such as Media, right? I guess you guys see a lot more of these China brands in our local electronics stores nowadays, right? So it benefited them. And other government policies, I guess, benefited electric vehicles, but now creates an oversupply, right? What other sectors would be? Maybe sectors such as, well, I'm just looking back. For example, the telco companies, because they had been pressured by government policies in the past. The government was trying to encourage high broadband, cheap telco consumption, right? In the past, encourage more competition. But in recent years, actually, that has tapered down. you now have more benign competition, right? And that is now and the telcos have high dividend yield, and actually over the past 1-2 years they have done very well. So it is not so much on actually I think it's not so much on how the broad it is more a consequence of the government policy that we should look at in terms of guiding maybe what are the possible sectors. But it's not so easy for those investors outside of China to grasp these policies that well, I would guess. As I mentioned, all these things, it seems very micro, right? Yeah, but these are the main beneficiaries.
But we do see that, in fact, year to date, as of first half of the year, I think in the A50 index has shown positive returns, 3.5% up. And maybe I just quickly shift to Alvin.
Yes.
So from where you are sitting, where are you seeing the investors' interests are coming back to China? How's the fund flows are like the year to date? Has there been generally a bullish or bearish sentiment today among institutions and among retail investors?
Yeah, sure. Hi everyone. I guess first of all, I really have to say that I really like the fact that there's a physical chair there, even if I'm not present. So yeah. All right. So I think in terms of how the retail investors, especially the investors who are investing in the China related products, we have all seen that. I think we have all remember that how bad the Hang Seng Index was last year, especially towards the end of the last year. And I think since the beginning of the year, there was a slightly bullish run, but then people still were not very optimistic about China, and all the way until around mid-April, when we have seen the index as well as a lot of the big sectors. Actually, that time around, in mid-April, it was not just the big cap stocks; it was also, the other a traditional, for example, like a telecom as well as oil stocks, all those together with the materials, more like a traditional sectors. Basically, most of them were on a bullish run from around mid-April to mid-May. I think that was when people really start to become bullish on China. And but then obviously since mid-May, Hang Seng Index has recovered, has corrected from the high of around 19,600 all the way back. And then it's still, if we look at the chart, it's still more or less on a downtrend. I think now people are more waiting for, especially the retail investors are more waiting for, if China is going to roll out some bigger policy, for example, whether they will cut the interest again since February. And I think now that the Trump is very likely to win, and then people are expecting that FOMC is going to, cut the interest rate earlier than expected. And then actually, this I think will give more room for the Chinese government to have more flexibility on the policies they can roll out, for example, to further lower the interest rate. And so I think people are still bullish on China, as we can see from the funds flow, because if we look at, for example, the daily leverage certificate funds flow, and if we look at the outstanding funds flow, meaning the actual amount, dollar amount of DLC people are holding, if we compare the bullish DLC, which is the long DLC versus the short DLC, we can see that I would say actually the majority of the funds, around 80% of the funds are on the bullish long DLC. And in terms of the sector, I think quite a lot of the funds were actually flew into the Hang Seng Tech Index, as I think investors, from what I see, especially Singaporean investors, when they bullish on the index, they tend to bet on the Hang Seng Tech more than the Hang Seng Index or the CDI. Yeah, and then in terms of the single stocks, I think from what I see is still pretty much on Alibaba and Tencent, and a little bit of Ping An. I think actually these three stocks are more actually underperforming if we compare to other more like oil or China telecom stocks that have been on a bullish run. So maybe people are betting that they will these three stocks will probably catch up at some point.
Thanks, Alvin. Yeah, maybe let's quickly move on to fundamentals, because one of the panel questions is also what kind of instrument to utilize is recommended. We do see that back in 2021, when Asia's market got a return of 31% based on FTSE Asia index, the HSCI index was flat that year. So you could see that performance across different stock market, though it's all Chinese companies, could diverge at some point. So maybe bring the focus back to Jeff. We do know that in Singapore, we have over 100 stocks that do have China exposure. They are listed on SGX as well. So how should investors probably look at all these available, like thousands of tools, and really make a choice? And there's a question as well, how to better position if US and China relationship burns up. So could you probably give some color on, the options available, and how should investors really look at it when they are considering their approach towards China?
Okay, yeah, as you said, we've got 100 stocks that report more than half their revenue to the mainland or base more than half their assets in the mainland. There's a great range of businesses and sectors represented by those 100 stocks. If you look at the 5 that have attracted the most net buying from institutions so far this year, it's both Yangzijiang Shipbuilding and Yangzijiang Financial. It's Hong Kong Land, Tianjin Pharmaceutical, Darintang Pharmaceutical, and also Geoenergy Resources. 4 of the 5 stocks have generated gains so far this year. I think Yangzijiang, of course, outlier gains again. I think, as I said, they're 5 different sectors, and they're not, you can apply all different type of metrics. You can see, Yangzijiang obviously trading at valuation premiums to their long-term averages, but at the same time, I think it closed today at $2.35, and the consensus estimate target price is still higher at $2.63. Hong Kong Land closed, I think, at $3.42, and its target price, I think, is at $3.62. And then, we've got, among those 100, we've got SASA REIT, which invests in outlet malls in China. That's closed at 68 cents a unit today. Target price is 98 cents a unit on our stock screener. So I'm kind of, putting together some of the institutional flows, what the actual brokers and the intermediaries are saying for their projections. They still seem obviously quite bullish on certain segments and sectors that are I guess, more defensive than the cyclical consumer technology plays. But if you do want some of that volatility in the consumer tech plays and so forth, you can start with our ETFs. Our ETFs, we have 12 ETFs that track stock indices in China, including the Phillip Capital ETF that launched recently. The most traded and the highest AUM that's based here of those 12 is the Hang Seng Tech ETF, and Alvin was talking about the Hang Seng Tech Index, and it's a real mover. You've got every day between high and low this year, you've had 2.6% trading range. So there's a lot of vibrancy in that market. It's very highly tradable. Overall, 12 ETFs that track China indices. No, sorry, 10 China ETFs that track indices, and the 2 ETFs that track the China bond markets make up around 15% of our total AUM here. So there's quite a demand, and it resonates also with that 100 stocks in our stock market as opposed to the 500 stocks total. So you see the investor interest in the stock market also paralleled into the ETF market.
Thanks, Jeff. Just on that point as well, on instrument type, and I think most of you might have heard about ETFs, as Jeff has mentioned. So again, for maybe this question more for all three of you, how are you seeing passive investing taking shape for China market? Maybe start off from Teck Ling. Do you see investors gradually shifting towards passive investment, even for China? And also, I think recently there was a new ETF launched by Phillip Capital. If you could share a little bit more, like why did Phillip Capital chose the index, and how does it serve, investors when building the exposure to China?
Yeah. Well, let me relate it to this question here. Which sectors in China has better promise to make good in the near medium term? Actually, if you ask me that, I can tell you, I also cannot really tell. You know why? I mean, I can say I'm a China observer, but I can't say I'm a China expert. Because, you'll be trading against you'll be buying stocks against the millions, even billion of population in mainland China who are much more familiar with the local stocks and the local situation, the local sectors, the local policies. So how even if a certain sector, right, say the high-end manufacturing has a bright outlook because the government supports, that would probably be priced into the share price, already. It's like one of the biggest ones, Foxconn, internet is that does smart manufacturing and robotics for China factories, right? Cloud platforms, all the industrial internet. It's called Foxconn Industrial Internet, sorry. So it's trading at 20 over times PE, for example, right? It's the leader in that field. So how do you get exposure to China in a reasonable sense? So that's one of the driving reasons why we developed this A50 ETF, right? That was in March, right? China A50 ETF was in partnership with a leading mainland firm, China Universal. So it's Phillip Universal A50. The idea is that you provide an instrument that gives you a diversified exposure to the leading 50 companies in mainland China. And why China A50? By the way, the A refers to China domestic shares. That means the mainland, because I guess if just for education, so some of you may not know, of course, because you're familiar with Alibaba and Tencent, which is listed on the Hong Kong exchange, that's considered offshore. Or you might be familiar with NIO or whatever is listed on the US ADR.
And SGX as well.
Yeah. And so all those are considered offshore China stocks, right? Right. But this, if you look at the whole China stocks universe by market value, this is just 1/4 of the total China stocks by market value. Actually, 3/4 of the value lies in mainland China, right? And you have much more stocks, thousands of stocks that you will not find listed offshore. So if you wanted to get exposure to China, you would be looking at more of China A shares. And that's also the reason why we did enter ETF focusing on China A, right? So 50 leading China A shares through this ETF. So essentially, I think the key thing is, if you wanted to get exposure to China in a long-term manner, right? It is probably getting exposure to something where you get exposure to the leading companies, right? And that's refreshed constantly because the index rebalancing and so on. So that is a reasonable way. Yeah.
Yeah, maybe just on the use of instrument as well. Back to Alvin. We do know that DLCs have the ability for investors to go into a leverage or even an invest position if they are bearish about the market. How are you seeing investors using DLCs besides for taking a position on the movement? What other means does it serve to investors? How does it help for them to supplement or rather complement their portfolios?
I think first of all, let me maybe supplement a little bit on the question regarding like passive investment, because actually Hang Seng Tech Index, Hang Seng Index, they're also like an index which you know, if we build a ETF on it, then obviously it's a passive longer term investment. But then you can also obviously have a leverage product version on those indices, and because as Teck Ling mentioned, if you have like a different stocks, you know, combined as an index, you have a benefit of a diversification, and that actually can lower the volatility of the entire index by a lot, you know, by compared to the individual stocks. And if we are talking about especially volatile stocks like tech stocks, for example, then having an index on tech stocks obviously would greatly reduce the volatility of it. And then if we want to bet on the direction, you know, have a short-term view, sometimes you'll probably find that it's more beneficial to have a long DLC on Hang Seng Tech instead of the long DLC on the, you know, other individual tech stocks. And so in terms of how investors can use DLC to express their view, I think first of all, maybe let me just we spend maybe just like a half a minute or 1 minute to quickly talk about what DLC is, because I understand that maybe not too many of you have traded DLCs before, because I think DLC, you know, is a certificate that is listed on the SGX, and it's obviously with a leverage. So by nature, it's a shorter term investment product, and you can see that for single stocks DLC. So we have a lot of DLC on covering Hong Kong stocks and Singapore stocks as well. Most of them are 5 times leverage, meaning that whenever stock goes up by 1%, your DLC will go up by 5 times of it. So 5% whenever stock goes up by 1%. So by nature, you won't hold that for too long. And so we see a lot of investors using DLCs for short-term trading. For example, Hang Seng Index, I think over the past 2 months, it's been on a downtrend, slight downtrend, not a very big one. But then actually it's been hovering up and down, most time within, say, Bollinger range. Then we have seen some investors who do a swing trading on the Hang Seng Index DLC, for example. And but obviously, besides being a leverage short-term trading product, we do see some investors who use the short DLC to hedge against their portfolio, because some of them, you know, if they hold a stock that is more a long-term holding, either Hong Kong stock or Singapore stocks, they can use the short DLC to hedge against their stock portfolio, because, for example, if they foresee that there might be some events that will happen, for example, I don't know, like a US election, for example, something that can either make the market go up or down by a lot. During these kind of scenarios, they can use a short DLC to, especially short DLC on the index, to hedge against the stock portfolio. And if their stock picking is correct, then chances are their stock will outperform the index. And they don't have to hold a short DLC position for too long. They can hold it for maybe just 1 or 2 days of time to do a short-term hedging, and then after that they can just unwind the DLC. And because of the fact that if they trade single stocks, they will obviously have to pay stamp duty when they trade Hong Kong stock. But then if they trade DLC, they will not be subject to paying stamp duty. So that's why I think most of the time you see investors who use the DLC to do a short-term hedging instead of trading on their individual stocks.
Thanks for sharing, Alvin. And by the way, we do offer DLC across Hong Kong, US indices, and we do have Singapore indices as well. And that extends to single stocks. Most of the Singapore index stocks are available under DLCs, including some China-related names. So maybe let's move on to the last question, running out of time. More personal question to all three panelists. I think most of the earlier question we asked at the start, most of you are vested in China, the audience. So for the three panelists we have today, what's your approach towards China today? What risk factors you would like everyone to bear in mind? And when it comes to allocation, how do you get started? Maybe from Teck Ling, I think you're ready.
Well, I guess I mentioned some of the risks, and that is also well published. The China's plan is to transition to a dual circulation economy, right? So how are they able to do it? We will have to watch on the property front some of the moves, right? They made some moves recently to sort of curtail this problem, but I guess people are expecting more to come, so that's probably what bears watching on the property front. The other one is the geopolitics of things, right? So I think my view is, I guess now is there's some jostling for who is the more hawkish US president right now, because it's electioneering time. So we will probably watch a bit more on this front. So I think over the China does have some structural strengths, right? So they are a major economy. So over the years, they have a track record of growing their GDP over the past few decades. So there is some, and because of that, and the fact that they actually are, by purchasing power GDP, purchasing power parity, they are the world's largest country already. Purchasing power parity means that what the per unit of GDP actually can buy in terms of the goods. So actually the real purchasing power. So they're actually the world's largest, even larger than the US. So they do have the critical mass, right? If they wanted to I mean, in terms of domestic consumption, right, they do have the critical mass already, right? They have accumulated that over the past few decades. I think what best watching is how aggressive the Chinese government will be to boost the economy, because now it's a confidence problem in terms of consumption. They have all the resources. I mean, they have the world's largest forex reserves, over $3 trillion US. Their debt is not high. Government debt is not high, at least compared to major advanced economies. So they have made a series of moves this year to try to, I mean, they have been more active compared to the last 2 years in trying to boost the economy. We'll be looking at how they are moving to try to bring the China economy to 5% GDP growth. That's their target, right? And if that is something that appears to be achievable from future data, I guess it's probably time to be a bit more optimistic. Yeah.
For Jeff, what would be your approach to allocate?
You got to watch the world. It's, I think, really exciting because you're going to have a whole new global competitive marketplace. You've got the US wanting to bring in tariffs, remanufacture itself, reindustrialize itself, build its manufacturing sector. You need money for that. You need capital expenditure, you need operating expenditure, and you also need fiscal discipline, which means your interest rates aren't going to go as low as they have been. So interest rates are going to be relatively high, but not obviously not as high as they are now, but there will be need for them to be higher. Now that's going to create issues when much of the world still conducts 90% of their global payments in US dollars. So there is going to be a need for a lot of countries and a lot of companies to look for alternative funding currencies to facilitate transactions. And, you know, next cab off the ranks, obviously the world's biggest trading partner. So there's going to be demand for renminbi. And when you've got the world becoming more competitive, particularly in tech, where you've got just as much output, but less efficiency because you're disengaging with value chains, you're going to have more choice as a consumer, but also those companies that you're investing in, if they are less efficient and more sensitive to higher interest rates, it's going to be time for trading. You know, the markets are going to be potentially more tradable. At the moment in China, they're investable and kind of tradable. They're not, because so much rides on industrial policy and there's not a consistent update on what's happening in industrial policy or a steady stream of big reforms every single week or every month, you've got demand for DLCs, you know, because when you do have the big event or the big engagement, that's when the investors can really engage in the market and maximize their returns and risk for the DLCs. Now, if it is going to be a little bit more volatile, a little bit more tradable, just like physical trade, you need to collaborate, and you need you've got great issuers who set the ETFs and set the rebalancing and the passive strategies involved with the ETFs. You've also got, as we said, 100 companies here that have a good foothold in the China market. Some have very passionate investor relations and management teams that really want to meet and engage the retail investors and have you as a part of their journey. So do engage them.
So Alvin, maybe any final advice probably to the audience?
Yes, I think if in terms of how we can use a, say for example, DLC to you know, get access to the Chinese market, I think first of all, if we look at HSI, I think everyone would agree that it's not very bullish lately. Over the past 2 months, it's still a little bit downtrend, but I think it's a you know, if we look at US, we have seen like a very long bullish run for over the past years, but chances are, you know, when the US market really start to cut the rate, and then when the Chinese economy is really start to recover, you know, things can turn around. And then I think it's probably a time that I think we should pay more attention to the, you know, Chinese related sectors. And DLC can be, you know, one of the instruments for you to choose. But then I think if I were to make just one comment about the DLC, I think it would be that the Hang Seng index lately is still not in a very concrete trend. So if you want to invest in related DLCs now, I think don't hold the DLC for too long, because it's been hovering. It's been more like a sideways instead of having a trend. So if you hold the DLC for too long, you know, chances are you have a compounding loss on it. So I think I would say as a rule of thumb, I think for you, especially for you who are quite new to DLC, I think don't hold DLC for longer than a week. That would be my advice.
Thank you, Alvin. For investors who wish to find out more about DLCs, please do check out SGX and also UBS website for more information if you are totally new to it. So we have come to the end for today's panel discussion. Unless anyone has burning questions, you are still around, so certainly do reach out. So I'll pass on the time next to our speaker of today, Ms. Liu Miao Miao, and she will be sharing a very interesting topic. It's on unveiling the giants, a prognosis of China-linked corporations. So before Miao Miao started, maybe let's also give a round of thanks to Jeff and
oh, okay.
You can use this.
Okay, thank you. Hi, I'm Miao Miao, Rate Research Analyst in Philips Securities Research, and I'll be sharing on unveiling the giant of prognosis of China-linked corporations. So ever since China emerged from the pandemic, its stock market has been substantially lag behind the rest of the emerging markets. It's supposed to be a very fascinating recovery story, but turns out the recovery takes longer than expected. And this is primarily due to the housing market crisis. It had a negative impact on the household sentiment and also creates a ripple effect on the overall China's economy. And with the intensified geopolitical tension, it imposed an even more challenging environment to the China-backed corporations. But with the recent rally of A-share and also more encouraging macroeconomic data, we are seeing more investors, they are relooking at China market. And we have a very cute AI-generated graph here. It's a bull sleeping and ready to awake. So I believe the situation actually presents a very unique opportunity for investors to look at China assets. Yeah, so this is our disclaimer. Yeah, we put it up for compliance purpose. So we'll be going through some macro drivers like GDP, export, followed by property markets, some recent updates on property market. And something more correlated to China is tariff from the US presidential election. And finally, we'll be sharing 3 investment themes, and there will be 3 stock pitch. So macro drivers. We have GDP just released this week. It came in below forecast. The second quarter GDP lands at 4.7%. So it's below expectation. So the expectation was around 5.1%. But to be fair, GDP is still growing, but at a much lower pace than expected. Especially compared to the first quarter 24, GDP was around 5.3%. But we believe it's still keeping the full year target of 5% in reach. And overall, China's GDP will be supported by export and consumption, which we'll talk about later. And today is the last day of the third plenum, which is the most important meeting in China. It happens every 5 years for the top ruling member of the Communist Party to gather together and talk about some policies. So we believe there will be more stimulative policies after the meeting. And export. Export has been one of the major growth drivers for China's GDP. And it accounted for more than 20% of the GDP now. It's pretty robust. It increased by 8.6% in June 24. So we believe the same for China this year would be export-driven industrial growth. And at the same time, we are seeing trade surplus, record high trade surplus of 99 billion. And this is the highest ever since 1981. But with the increasing trade surplus, at the same time, we are hearing more noise over tariff, especially from the European side. Belgium increased the tariff on EV from China, increased by 37%. And other countries were following behind, such as Canada and Turkey. Even Indonesia increases tariff on the textile products over by 200%. So probably we are seeing more front-loading orders reflecting by the export numbers. But China companies are also becoming smarter. They usually adopt a China Plus N approach. So they have been shifting some plantations away from the mainland China. So they're going to Cambodia or Vietnam. Yeah, so going forward, we believe export will continue to be China's major growth driver for GDP. So the ongoing tariff has been adding pressure on the already very sluggish manufacturing activity. And manufacturing in June was at 49.5%. It's still falling into the contractionary trajectory. And but some of the authorities that have been argued, the actual number, the actual situation on the ground actually is better than the data suggests. Probably PMI fails to capture the full momentum of the very robust China export. But we believe the situation could get better in second half this year, as some of the investment, they have been shifting away from the secondary sector and they are going to the manufacturer side. Yeah, so probably in the second quarter, we'll see some uptick in manufacturing activities. And moving on to retail sales. Retail sales, China has been long having three very important GDP growth drivers, which is export, infrastructure, and consumption. But retail sales has been pretty disappointing in June. It came in at 2% and below expectation of 3%. This is probably due to the very high base last year, as China just came out of pandemic last year, and there was like pent-up demand and revenge consumption going on. So in 2023, there was a pretty high base. And the same thing happened in the e-commerce side. China just had a month-long sales promotional events called 618. And we are seeing the first time decline ever since the word 618 has been created. Yeah, and instead, other than the high base last year, we believe one other factor would be employees are slashing their salaries, and there's also very high youth unemployment rate of up to 13% in June 24. So this has been shrinking Chinese consumers' disposable income. And on the ground situation, we are observing customers are becoming more price conscious, and they always seek for value for money products. And so we'll be introducing one stock later called Cesaret, and we believe they are able to capture the full momentum of the whole China consumption downgrade and changing consumer preferences story. Yeah, so a lot of the indicators that we have shown, such as manufacturer and retail sales, they have been calling for more stimulative policies. As the graph shows, 10-year bond yield is already at 2.3% level, and LPR is also trending lower at 3.45%. And this suggests a more affordable mortgage rate, and also they have been encouraging household and also corporates to borrowing and also investing in other sectors. I believe after the third plenum, probably like there will be more like monetary easing. And something that is highly correlated to the lower LPR, which is fixed asset investment. This has been growing undoubtedly. So in second quarter 24, fixed asset investment increased by 4%. Although it shows a slight contraction from first quarter 24, first quarter 24 was at 4.3%. The marginal slowdown was mainly due to decreased investment in property market. And also some capitals has been shifting away from the secondary market to manufacturing activities. Yeah, that's why we believe PMI could probably like go back to the expansionary trajectory again. Yeah, so something that investor has been worrying about is our property market. In the beginning of the year, sentiments towards property market has been pretty pessimistic, but we're here to say the reality is probably worse than sentiment. There's over 100 developers in China that had been reported their first quarter result. And overall, sales decreased by more than 50% year-on-year. And like mentioned, investment has contracted by more than 10% year-on-year. And in June, housing price also shown a 0.7% month-on-month decline. And it marks the 13th consecutive decline. But we believe bad news may not always be so bad, because housing market is so important to China. It contributes to more than 30% of the overall economy, and it's so weak at the same time. Probably now, like central government would be having more stimulative measures, like monetary easing. So perhaps it's a good time for investors to relook at China's risk asset, because after like more monetary easing, this will just substantially de-risk the asset. Some of the measures which government has been released this year, including minimum mortgage rate, is already falling below 3%. And also minimum down payment ratio, it decreased from 20% to 15%. And more than 20 cities, they have abolished the new home buying restriction. And a lot of the local governments has been granting subsidies for people buying the new flats. And at the same time, local governments are also stepping into the market to getting rid of the excess supply. Yeah, they do this through buying new like unsold apartments and also turn them into affordable housing. So this will be the China version of the HDB. In this way, they can rebalance the supply and demand. And moving on, we have US presidential election. So ever since Trump was shooting by the gun, his success rate has been keep going up. Yeah, sorry, we didn't update the graph. So his spotting rate should be more than 70% now. And he has high odds of winning, or he already won the election. So if Trump take office again, highly likely he'll follow through the tariff of imposing tariff to Chinese products up to 60%. And without any mitigation factor, this would reduce China's GDP by 2 percentage points. This is just a huge downside risk for China's overall economy. But we can always learn something from the history. So for the first trade war, so here's the timeline. In 2017, we have Trump took office and he has begun to investigate some of the trade-related issues. And in 2018, trade war officially kicked off. In 2019, he imposed more than like 300 billion of the Chinese products. So the tariff was ranging between 7.5% to 20%. But what happens after 6 years or 7 years? Today we are at 2024, and we are seeing China having record trade surplus of 99 billion. And they still export $500 billion of the products to the US in 2023. Even though Biden administration imposed an 18 billion tariff on China exported products, but it's only a fraction of the total aggregate amount. And some of them, they may find it hard to be replaced, hard to find an alternative. So it'll just prolong the effective date of the tariff. So Chinese policymakers may be calmer and less reactive this time. And overall, we are still optimistic about China's export in the short term. We believe Chinese products are still very resilient, no matter that is price-wise or quality-wise. So going forward, they'll just export will continue to be one of the major GDP driver for China. And moving on, we have the investment themes. Yeah, so this is our most important graph of today. Not only because we're having an SGX presentation, but also because Singapore's valuation is very attractive indeed. So it's not at record low, like 10-year historically low. Compared to the other markets such as China, China falls nicely on the orange line. It's just one standard deviation below the mean. And on the other hand, US is already like record high. If you can imagine it, it should be on the top of the graph. Yeah, so according to mean reversion, we believe Singapore's valuation would slowly bounce back to the 10-year average level. And for the China-backed corporations, they have even lower valuation compared to the pure play Singapore company. So now is probably a good time to accumulate China-backed corporations. Yeah, the first thing we have is high dividend yield. But we talk about CSR rate. Yeah, so CSR rate is the first outlet mall listed in Asia, and its market cap is around 925 million. So we have long been hearing the word consumption downgrade. Like mentioned, retail sales has been so muted ever since the pandemic. So we are seeing shrinking disposable income for household. So instead of buying the large ticket size item, they'll just turn to the value for money products and bargain products. That's why CSR rate comes to picture, since they cater towards the middle income families. And China has the largest proportion of the middle income families. They used to shop for luxury products pre-COVID, but with the shrinking disposable income and less confident to spend, they'll just turn to the off-season luxury products in the outlet mall, since they can have the same quality and same brand, at the same time, it has a pretty high discount. So CSR rate, they currently have 4 outlets, one in Chongqing, Liangjiang, Bishan, Hefei, and Kunming. They also have a pretty diversified tenant mix. So they offer like a lot of the local Chinese products, and they contributed to 43% of the total sales. CSR rate also have a very unique business model. So they have a fixed component and a variable component. Fixed component is provided by their sponsor, very generous, and it packed to 3% annual rental escalation to well hedge the inflationary pressure. And they also have a variable component to pack to tenant sales, and this is able to capture the momentum of the upside. Yeah, so here are some photos. Since China is so far away, we can take a look at the photos. So they have a very unique offering for each of the outlet mall. The one in Chongqing, Liangzheng, if I remember correctly, they have a very big strawberry farm for their VIP members to have strawberry picking. And another one, they have a real person CS shooting game. So companies can have their team bonding event there. And another one is they have a super big zoo inside the shopping mall. Yeah, I really want to take a look. So their investment merits is all about tenant sales. In FY23, tenant sales up by 31.7%. And in fourth quarter 23, it increased by more than 84.6%. So for past of the years, tenant sales for success rate has always been outperforming China's retail sales in general. And retail sales came in May was at 3.7%. I would believe in FY24, Celsius retail sales will continue to grow at around like 10% level. And its occupancy rate is also picking up. All the outlet mall has around like above 95%. So it shows confidence are slowly coming back to the physical retail side. They are also the rate with lowest gearing in Singapore. Its gearing is around 25%, and they are eyeing acquisition in Xi'an side. So upon successful acquisition, this would raise DPU by 4%. But something we should take note of is the downside risk. Since like Celsius generates income in RMB and they'll like change back to Singapore dollar for distribution. Since RMB depreciated by more than 2.5% year on year, so yeah, it just will negatively impact on DPU. And they also intend to keep 7% of the payout ratio. This is to pay down their upfront payment of the RMB denominated loan. So moving on, we have earnings growth is China Aviation Oil. China Aviation Oil is the largest physical jet fuel purchaser in Asia. And it also plays a very critical role in China's civil aviation industry. It owns 33% of the stake in Shanghai Pudong International Airport, and that is the second largest airport in China. So pre-pandemic, the profit from associates, which is Shanghai Pudong International Airport, accounted for more than 70% of the total profit. So because they are the only jet fuel suppliers for all the international airlines departed in Shanghai Pudong International Airport, so they are basically the monopoly there. And with the uptick in international air passenger traffic, it already increased by 3 times year to date. So we believe profit for CAO from its associates would double this year. And apart from profit from associates, they also supply jet fuel globally, especially to China, since China is one of the very major jet fuel exporters in the world. And with the increasing air traffic, this would also increase its trading volume and thus increase profitability for the trading side. And apart from its very visible earnings, we also like its attractive valuation. Their market cap is currently 750 million, and they already host like 370 million cash in hand. So 50% of the market cap is made up of cash, and their multiples is also pretty discounted. Forward PE is at 7 times, with forward EV over EBITDA of 2.9 times. Yeah, so the last thing we have is stable recurring income. We're talking about CLI, Capital Land Investment Limited. So revenue for CLI are mainly coming from 2 parts. One is fee income, the other one is lodging business. And they manage over 133 billion in the real estate asset. And they are also the partner for a lot of the very big REITs, like Capital Land Escort Trust, Capital Land China Trust. So basically all the name like starting with Capital Land. And they also have 20% real estate investment business in China. So 2 major revenue drivers for CLI this year. Firstly would be its increasing fee income, since the market has been generally pricing in more than 2 rate cuts this year. So this would just boost the acquisition and divestment activity. And the CLI already divested 600 million of the asset, and it shows more than like 20 times increment from last year. So they are pretty much on track to hit the 3 billion annual divestment target. And they also have 9 billion dry powder ready for acquisition. So they are committed to double their FUM fund under management within 5 years. So we probably will see like phase from the acquisition side to be double within 5 years. And for its lodging management fee, we are seeing it to be improved. In first quarter 24, there's more than 4.6 thousand units was signed across 22 properties. And since hospitality sector has been performing so well globally, we believe going forward, lodging management fee will continue to grow. And lastly, we would like to mention is China exposure, which is China CapitaLand China Trust. CLI do observe there is like lower contribution from the China side, and especially some sector has been falling behind is the new economy side, such as business parks and logistics. Since the e-commerce, they expanded way too much during COVID. So with the pretty muted macroeconomic situation, they are cutting down space. So there's a negative rental reversion going on in China market. But retail side is still positive, is still showing flattish rental reversion. And with the ongoing AEI effort, we probably will see a positive rental reversion soon. Yeah, so that's all for me. Thank you so much for listening.